Hi there, Chris Murphy from Money Vineyard, Growing Your Money. It's a site about value investing, and this is kind of a video explaining this blog post right here called How to Value the Stock Market. And this is really useful information, how to value the stock market, because it tells you whether, obviously whether the stock market is really expensive or if it's cheap and it's time to be in stocks. So it tells you if it's pricey and you want to avoid stocks, or if it's cheap and stocks are a good value. And this technique was kind of developed by this guy right here, Ben Graham, pretty well known investor and teacher, the guy that taught Warren Buffett, a billionaire investor these days. And anyways, Ben Graham developed kind of this technique, and here's kind of a cheater's way to calculate it really quick. And before I show you this quick little cheater's way, what the technique is you calculate what's called the yield on stocks, and then you're going to compare that yield to the interest rate yield. And if the stock yield is 2 times the amount of the bond yield, then you can pretty much it's a pretty safe bet to imagine that stocks are going to outperform bonds, and vice versa. So if the bond yield is 2 times the stock yield, then it's a pretty safe bet that bonds are going to outperform stocks. Now we look at this graph here real quick. This area here was when when bonds yielded 2 times as much as stocks. And as you can tell, the stock market did very poorly. This area here was the market crash of 2008, and it was a time when stocks yielded twice as much as bonds. So it was a good time to be investing in stocks because they were cheap, and bonds were pretty expensive. So here's a quick way to calculate that really easily. You just do a quick Google search for 10-year trailing PE here. I'll show you. Quick Google search for 10-year trailing PE, and you'll find this site. Go there, and here's the current PE, and here's how you get the stock yield that I was talking about earlier. You take 1 divided by this current PE, so it's 1 divided by 19.91, and that gives you your current stock yield, which is about 5%. Now you're going to compare that up here to interest rate, which is kind of your interest rate yield, and right now that's 3.24. So stocks, they don't exactly yield 2 times as much as we're calling these bonds, but this is the interest rate, but it's equivalent to bonds. Stocks don't really yield 2 times as much as bonds right now. They do obviously yield quite a bit more, but they don't really have that 2 times margin of safety. So right now, stocks are probably your better investment than bonds right now. But again, they don't have that 2 times number. Yeah, that should do it for now. Here in a second, I'm going to show you how you can take this knowledge and kind of turn it into a strategy where you can allocate your portfolio to either mostly bonds or to mostly stocks, and show you how to do that and how you can just take a couple minutes, actually every year, just a couple minutes a year, and you would have vastly outperformed the market over the past 10 years, and you can take that knowledge and use it to most likely vastly outperform the market over the coming 10 years. So that'll be the next video here, and I look forward to posting that and hearing back from you all. Thank you.